It is now 9:30. We promised to get started on time. We're going to start, and the first thing is introducing my colleague. Sam Rhodes is not here today, so I will stand in for Sam. Introducing my colleagues, Heather Hanowitz, who is Vice President and Senior Loan Officer, and working with her is our Loan Officer, Evelyn Montalvo. These are the two people when you have an inquiry into PIDC because you need financing, whether you are buying a building, renovating a building, leasehold improvements, working capital, you need to fund receivables for a contract. These are the people who make it happen at PIDC. So it is a pleasure to be able to have the professionals of PIDC host this webinar on today and provide you with information that will not only assist you with navigating through PIDC's loan process, but also as you are seeking financing with traditional banks. There's not too much information you're going to hear today that is not also applicable to any lender that you will seek. And so with that, I am turning it over to Heather Hanowitz, Vice President in the Financial Services Group and Senior Loan Officer, and Evelyn Montalvo, Loan Officer at PIDC. Heather, take it away.
Thank you so much, Marla. Good morning, everyone. It's a pleasure to be here. We're so excited to be able to connect in this way, even though we would much rather be in our beautiful office, shaking hands and saying hello. As Marla mentioned, Evelyn and I, along with the other members of our business lending group, are really here to help support you through the application process every step of the way. And a lot of times we find that we have great conversations, we go over our loan programs, everyone gets really excited, and then they see our application, which you'll see today. This is the first time we're going to be promoting our new online application. But folks, sort of in many cases, get intimidated by the application process. And so we get together, typically, I guess now it's quarterly, to really talk through and answer any questions about the application process and what these materials really mean to us and how we're evaluating them. So you're going to get a chance to really see sort of the rationale and sort of see the process through the lens of your lender. And as Marla said, PIDC is certainly one lender, but this is really applicable to any financing that you end up seeking throughout the course of your business. So we really want this to be interactive. There are a lot of ways to connect through the chat, through the Q&A, and because Evelyn and I will be working together, alternating our presentation, we will do our best to incorporate your questions live, and then we'll certainly leave some time at the end. But please don't hesitate to virtually raise your hand. So with that, we're going to start with some of our specific loan programs, and certainly Evelyn, if you'd love to introduce yourself.
Hi, Evelyn Montalvo. I've been with PIDC for about going on 11 years. And prior to that, I was with PCDC for about 23 years. And in that time, of course, I've participated in many workshops and provided lots of loans for different kinds of businesses, and look forward to doing that and continue doing that in the future. So we're going to go over some of the four major programs that we have under small business lending. And if you have any questions, like Heather said, please let us know. Next slide. Okay, these are two of the programs that we have. It's the working capital and equipment loan and the contract line of credit. Both provide financing to small businesses. The working capital and equipment loan can be used, of course, for working capital, equipment, and machinery and equipment, leasehold improvements, and at times for the purchase of real estate. Under this program, we can also do some, when the working capital, we can do some refinancing if the business has debt and high interest debt, and you want to refinance it, and the interest rates are, of course, higher than 6.25, which is what the interest rate in this program, we can certainly help you with that financing. The terms under this loan is 3 to 5 years, and the loan amounts are anywhere from $50,000 to $750,000. Also, the business must be located in Philadelphia and be operating for at least 2 years. Any questions under this program? Okay. Okay, moving on. The contract line of credit. This provides support to small business, minority-owned and disabled-owned businesses. It helps them with funds to fund the contracts that they have. If you have contracts with a public or private agency, we do bridge receivables. The interest rate is 3.5% and requires the assignment of the contract proceeds. And what that is you would have whoever the contract owner is sign over an assignment to us saying that the proceeds are going to come directly to us because we would have financed that contract possibly a month or two before. What happens is this program was put together with PHDC many years ago to finance their contracts. And what happens is we get an approved invoice from PHDC. We will fund it, and then we'll hold on to till PHDC pays us the funds, which would be probably anywhere from 60 to 90 days. That's the way this loan works, and it's anywhere again from $50,000 to $500,000 at an interest rate of about 3.5%. Are there any? And this, of course, helps the business with achieving to provide immediate cash flow needs for your business as we wait for the proceeds to come from PHDC or whoever the contract owner is.
Evelyn,
Are there any
we have a
questions?
question from Free Howard Keg, excuse me if I mispronounced that. If you wouldn't mind unmuting your mic, we can allow you to answer your question live. Free, can you hear us?
I can't hear.
If you can unmute for us, you can go ahead and ask.
Or Heather, if you would like to answer the question live, that would be fine.
Great. Yes. So we have someone, and this is a really great question to start off
Okay,
with.
can you hear me now?
Yes, we can.
Okay, yeah, I'm sorry, I couldn't find the unmute button. Yes, we see businesses in Delaware County.
I'm sorry?
If your business is located in Delaware County,
Well, your business can be located in Delaware County, but it must have a satellite office in Philadelphia somewhere.
okay,
So
good.
if your
Okay, thank
headquarters Delaware, no problem. As long as you have a satellite office somewhere in Philadelphia, it's no problem.
I have, my business is a makeup artistry business, and I have 2 satellite offices. One is in Center City, and the other's on Temple's campus. But would that qualify as satellite
Yes.
offices? Okay.
Absolutely, absolutely.
All right, great, thank you.
Are you? Can I ask you a question? Are you interested in financing, working capital, or what is it you may be looking for your makeup business? I can't hear.
Can you hear me now?
Yes, I can hear you.
So my business has been hit hard with the pandemic. I do wigs and makeup and special effects for theater, film, and opera. And the Met, of course, just gave us a notice that they're not going to reopen until 2021 in the fall. Opera Philadelphia is following course, and most of the other major opera houses, Chicago Lyric, are all doing the same. It's very hard to get work, and when you do, instead of having hair, makeup, and wardrobe, or hair, makeup, and special effects, they want one person to do all 3 with one salary. So what I've been finding is I hire people for a job, and then they say, oh, there's a limit on how many people are able to be on set. So then I have to pay people for the work they've already done but I'm not getting recouped that money because they're lowering the number. And I don't know how I'm going to survive doing that. Like I've done that 3 times. From Temple University, one, and they said, okay, there's going to be 2 people. And I hired the people, and then they said, oh, we have an emergency meeting. They're not allowing scans. So you're going to have to teach them how to put wigs on with Zoom. But I've already style wigs, so I don't know what to do without getting some kind of financing.
This, Heather, this may fall under the restart, I think.
Yeah,
Okay.
so I think, one of the things that we're seeing, and part of, I think, why this is such a timely session for us is that we and most lenders are having to reimagine the way that we underwrite. Normally, when, in a normal economic environment, we would be looking at the last 2 to 3 years of your financial statements and really trying to understand and predict how the future will unfold for you. Everything's been turned upside down for most businesses we've seen. And so and we'll get to this section, but part of what will be so important for us to understand with an application like yours is how is your business pivoting? And what are your new, we certainly want to know that you've been successful and operational in the past, and that certainly adds towards your business's capacity. And again, we'll get to the 5 C's of credit and how that sort of fits into the overall strength of your application. But we're also going to need to see what does the future look like and how have you pivoted? One of the members of our loan committee mentioned recently that we're really looking for the innovation factor, right? In times of uncertainty, and certainly we know some of that innovation may be temporary, but it sounds like you have some really interesting opportunities. We know they may not support you over the long term, but if you are able to, if we are able to support you over the next 18 to 24 months and support your pivot, that is certainly something that particularly the working capital equipment loan program is especially geared towards. It's our most flexible resource, has very little requirements as it relates to job creation, right? It has no requirements actually. And it's a fixed interest rate, which when you start to compare, some of the more sort of easy to access financing that you would see online, that's where we are really concerned for businesses that they, in a crunch will be taking the easy route to capital, to get your capital in 48 hours, but unfortunately maybe paying a high price for it. And now in most cases, in most scenarios, we aren't recommending that sort of predatory debt. In a time of a pandemic and additional uncertainty, it's even more important that you have a very clear, structured agreement. And we really pride ourselves on being that transparent partner through the underwriting process as well as through the lending process. So I hope that answers your question. Your case in particular is really great that we do have many businesses that have satellite offices. Their headquarters may not be in Philadelphia, but we want to know that there is head count in Philadelphia. And you can really think of us, because we are an extension of the city of Philadelphia's economic development strategy, we are really focused on business attraction and business retention. So as long as we can see that you are employing people and that you have a physical location here, you do qualify. And there's one other question, and maybe Evelyn, you can take this. There is an individual that's saying that she has a new business. It's only 6 months in business. So this is someone who started a business probably at the start of the pandemic. Wondering, can she apply? So I'll let you take that.
Well, we normally like to have a business be at least 2 years in business, but you can certainly under these circumstances apply. Under what program? What program would you be interested in applying? The person that asked the question, but
Jasmine, if you could unmute Letitia, please.
It looks like Letitia is unavailable. Letitia, if you can type in our chat or Q&A box
Okay.
for us, that would be great.
Okay.
Yeah, and
Or we
I
can,
would
or we can
say,
answer her.
yeah, and I
Go
would just add, Evelyn, that we probably have a number of people on the call that are in an earlier stage in their business. And one of the things that we, because we, together with Marla and certainly our team, we pride ourselves in being a connector and making sure that if for any reason your business is a little too early for us, we will make sure that you are connecting to the appropriate loan program, whether that's through a bank or another CDFI. And CDFI stands for Community Development Financial Institution, which PIDC, is a CDFI, a designated CDFI. We have a number of other CDFIs that we partner with throughout the city. And so we have you covered. We're here to make sure that you are getting the appropriate application for the stage of your business. And it may not be PIDC. We have made exceptions before, depending on sort of your business background. So if you have owned other businesses and are pivoting your business, that may be a reason for us to say, you know what, we absolutely can count this as, someone who has a history in the industry and has just decided to pivot. But a true startup, we don't want to make any promises until we talk to you. We definitely want to better understand what your needs are, certainly offline.
Yeah, and what Heather said, we can certainly refer you to other agencies that we partner with. So next slide.
Great. So the capital project loan and commercial mortgage loan, really think of this as, our programs for fixed assets primarily. So we are really interested in helping businesses buy the real estate that they either occupy or want to occupy. The commercial mortgage loan is something that we launched, I guess, I probably would be last year, maybe about 18 months ago. It is available as a primary mortgage for any type of commercial real estate, which can include mixed use properties. The key is that your business needs to occupy the property. It can have some rental income attached to it, but we want to see that you are purchasing a real estate to operate your business. Our loan size right now goes up to $500,000. We've done loans of various sizes so far. We've even seen this product paired with a bank note. So we have some flexibility to offer some participation if you find that your bank is not financing the full amount of your request. And we're able to offer a fixed interest rate for 15 years, which on the commercial side is pretty unheard of. A lot of folks really start comparing this rate to their residential interest rates. But when you compare it to true commercial real estate loans, most banks are offering fixed interest for 5 years. And then the rate is being reset after 5 years. We feel that offering a fixed rate for the life of the loan is really important. 15 years may be a little bit more accelerated of a repayment than you're used to. Most banks quote you at 20 or 25 years in amortization, but we, as much as we can, we try to focus on that 15-year term, get your business to fully pay off that debt. But of course, we have some flexibility if your repayment needs it. And then kind of back to the capital project loan, this is really a legacy product for us. I think most people who know PIDC know this product. We, just like I mentioned, there are options for subordination on the commercial mortgage loan. This is 100%. This is 100% subordinated product. So we want to see that your bank is willing to partner with us, is interested in really diversifying the risk, which in times of pandemic, I think is really attractive, especially now. And we'll finance up to 40% of the total project for both purchase of real estate or major fixed assets like equipment, as well as as renovation. This product, we're able to go a little bit higher, our traditional maximum of $750,000. And we really partner with your lenders. So we don't ask you to sort of double the cost of a lot of the things that you normally need to supply to a lender. We will accept the same appraisal as your bank. We will work with the same inspector as your bank. So there's some really great ways that we can partner and really make it a sort of an efficient and affordable option for you. And this product actually helps incentivize your job creation. So we are able to offer a lower interest rate below market. And the only requirement is that you create jobs over a 3-year period. So this project does require some job creation in order to really incentivize that lower interest rate. And we don't have it on the slide here, but you can generally get a sense that we're giving you $35,000 in credit per job that you're creating. So, we know in times of uncertainty, this might not be the best product for everyone, but there are a few businesses out there that are growing. And so we definitely want to make sure that you're aware of that.
And on this program, we usually call it the 50-40-10 split, which is 50% will come from your bank or other lending institution or lender. 40% will come from PIDC and 10% will come from you. So we require that you provide at least 10% of the equity. So it's an easy way to remember, 50-40-10 split. Next
Great.
slide.
And I just want to, I think
Okay.
there's one question here. It says, would a workspace office in Philadelphia be considered a, oh, okay. You guys are back on the satellite office questions. And I just want to make sure that I get to Michael's question here. So as long as you have a lease that you have signed, that you are committed to a workspace office. If it's a month-to-month arrangement, we may scrutinize it a little bit longer, excuse me, a little bit more. But we're really looking for, a traditional annual lease, and that can be a co-working space, but we do want to make sure that you're in there for the long term. Many times lenders are matching their financing to the term of your lease. So that's just something else to think about depending on what it is that we're financing.
Okay, reasons to borrow from PIDC, why you may not qualify for traditional bank financing. One, of course, your business or company may be too small, your credit score may be too low, not enough experience, you don't have enough experience in the business, you show no profits, which sometimes we have a little problem with that, especially with cash businesses, and unable to service a debt. You don't show in your tax returns, and we'll get into that, or your financial statements that you make any profit. So we look at, well, you don't have any profits. How are you going to pay? How are you going to pay the debt? How are you going to pay us back? So those are very important, and we'll get into that. Why it's important to show your true profit, so that we can help the business grow. And we also look at number 2, the credit score. The credit score is too low. We want to make sure that you're paying your bills. We look at it. If you don't pay your bills, you don't pay, how are you going to pay us back? Or we just question that. Common borrowers needs, you need long payment receivables, creating cash flow problems. This is where the contract line of credit comes in. You need money right away to keep funding the projects. We can provide that short-term financing and help you move your business along, because otherwise you will be stuck. Expand operations. Maybe you're looking for a second location. Maybe you have a building that you can purchase. Maybe you have a building that you're leasing or purchasing, and you want to expand it. You want to add a couple, more square footage. That would be a need. Reduce cost of borrowing. With some of the loan programs that we have, they are much lower than traditional bank financing. So those are some of the common needs that a business owners may have. Next slide. This is the flow of how a deal comes to PIDC and gets financing all the way to the end. If you look at number 1, the initial meeting or conference call, this can come in many ways. Either you can contact me, or your banker will call us. You can just call PIDC, a cold call. We will sit down with you and we'll go over the program. We'll have one of our business developers sit down with you and go over your needs. They'll figure out what kind of program you may qualify for. They will ask you to send us back information, tax returns, things like that, things that will help us evaluate you. Then we go into the pre-approval and discussion. We will look at certain things, your tax returns, your personal financial statement, your needs, how the business has been doing for the past couple of years. And then if we feel that the product or the service is your business and we can move forward, then we will go into the full application. And then we will need, of course, your business plan, explaining exactly what you want to do. We will review it. The underwriter, me, will review it. If I feel comfortable with it, we will move forward with internal approval, which is Heather, my supervisor. We will go through the whole project and see if the project qualifies. If we get all sign off on everyone's fine with the project and the amount and the collateral, because we evaluate all that, then it will go on to the loan committee. And we have loan committee every 2 weeks. We sit down, present the project, and they'll ask us questions about the project. If it's approved, then certainly it'll move to the board approval. And sometimes the project, it may be, very rarely is it rejected, because we usually feel very comfortable when we go to the loan committee with a project. At times it may be tabled. They may need some additional information, or may want to see maybe a couple more months of financial information before we could take it back to the loan committee. After it's approved by the loan committee, the following week it goes in front of the board for resolution. And then after that, we will draft a draft commitment letter, and loan docs. And then, if you approve and you're fine, you sign the commitment letter, send it back, then we can schedule loan closing. Now, this will take from beginning to end. It takes anywhere from 60 to 90 days. And I know it seems long, but it really isn't. Because there's a lot of things that we do, a lot of searches that we do, and we ask you questions about the project, because we certainly want to feel comfortable with the project. When we go in front of the loan committee, they ask us any questions that we know. So we are your voice at the loan committee. So that's kind of the process in a quick way. That's kind of the process at PIDC. Are there any questions?
Yes, Evelyn, there is a question from Paul. I'll ask Paul to unmute his mic.
Okay.
Hey everyone, how are you? So I actually have 2 quick questions. Okay, so the first question is business credit versus personal credit. At what points do these two separate, right? Are you checking on my personal credit to evaluate my business? Are you checking on my business credit to evaluate?
I'm searching credit on personal credit on anyone owning 20% or more of the business. And of course, we certainly would like credit 700 and above, but sometimes that doesn't happen. And we'll get into that a little bit later. We do have excellent workshops that can help you with organizing your credit and increasing your credit and so on. We'll get into that, but yeah.
So this is regardless of whether a company has a Dun & Bradstreet number and has a credit history, right?
Yes.
Okay.
Anybody owning 20% or more. Or a guarantor. If somebody's guaranteeing the loan, you don't, let's say you don't have enough collateral and you have a guarantor, a parent or uncle or something like that, that wants to, guarantee the loan for you, we will ask for their credit as well, for them to, their permission for us to run a credit report. Yes.
So a guarantor stands in place of the principal.
I'm sorry?
So the guarantor stands in place for principal.
Not stand in place, but they guarantee the loan. I mean, you as a principal are still on the hook, but this other person is going to probably be providing either marketable securities or a piece of property, to secure the loan.
Okay, so that's number one. And then number two, do you have stopgap loans or gap loans? So for example, we are in the personnel business, so we provide personnel. We operate on a net 30. Some clients come to us with a net 60 kind of contracts, which we do service. The problem is that we do have to run our payroll every 2 weeks, so we have a stopgap. Do you have those type of programs in place?
Yeah, that was the contract line of credit that I went over with you in the beginning. That helps with short-term financing for your business. Yes.
But looking at the process, it takes at least 90 days, so it doesn't beats the
No.
purpose, right?
Okay, no, not when I say 60 to 90 days, I mean for you to come to us, to talk to us till you get for closing. That's not for the contract line of credit. This is just for the process to get your loan approved, not for you to get financing. I mean, if once The deals that we're working with now under the contract line of credit, when they provide us with a approved invoice, we can pay that invoice within less than a week.
Okay.
Did I answer your question? Yeah.
It's a little confusing, but that's fine. We can
No,
take it.
I want you to be able to. I want you to be able to understand what I'm saying. What is it you don't understand?
So this approval process takes 90 days, right? The line of credit you're talking about, I mean, if you need financing in like a week, maybe 2, right? Or maybe 3 weeks, or maybe a month, right? It doesn't, the cycle itself doesn't sell. The cycle itself doesn't necessarily make cogent reasoning.
Well, it does if you have the contract line of credit. The 60 to 90 days is the approval process when you initially are approved for the loan. After you're approved for the loan, then it can be less than a week after you're approved for the, let's say the contract line of credit, once you're approved.
Yes, and one thing I would add is that I think what you're getting at is sort of a common need, right? Businesses in many cases find themselves needing money yesterday. And so what we are really promoting here is that you get an early start on your application before the financing need is really dire, so that we have a chance to get to know your business over 30 to 60 days. We get you the funding that you need. And then as Evelyn mentioned, the contract line of credit is with you every week moving forward. So it's really about getting the business prepared for financing before it actually needs it. And we know that, circumstances unfold all the time. We end up refinancing a lot of high interest debt, those kind of stopgap loans that you're talking about. We end up refinancing those for businesses typically 60 to 90 days after they receive them, because they realize how costly they are to their bottom line. So we're not here to judge whether you've taken those loans out or not, whether you needed them or not. We can really support you at any stage. It's just that if you're working with us, it's not going to be a 48-hour turnaround from application to funding. But once you're in our book of business, once you're a borrower, we will do everything we can to get your money as quickly as possible. And certainly on the line of credit that we offer, the contract line of credit, you are taken care of by our portfolio management team on a weekly basis, if that's what you need for your contract receivables. So it's think about this as, and with any lender, think about this as developing a relationship. We need to get to know you. We need to interview you. We need to really dive into the business and the, all of the roller coaster items that we see in your financial statements, get answers to them and be able to represent you. Evelyn mentioned that we are representing you at our loan committee. And so that takes time. And in order to do it really well and certainly fairly, we need the time to get to know your business. So it's not, unfortunately, we're not the fast option, but we will be the option that takes a little bit more risk and probably funds you a little bit more than anyone else who doesn't take that time.
Okay. I mean, just to make a note, a caveat, a statement, maybe.
Yeah.
For businesses that have been in operation for 3 years, I'm 100% ownership. For people like us, we don't have good credit because we put all our sweat and tears into the business.
And
right?
we know that.
So once you scrutinize our personal credit and ignore our Dance and Brad, you leave us in a vacuum.
Well, and that's where we're going to get to a credit section here. We're going through all the C's all in the beginning already. Here. But okay. You bring up a perfect example of what really drives the anxiety for most business owners when they come to a lender, because they do feel like they're going to be scrutinized personally. And what I would say to that is that we, again, are not here to judge the score. We are here to understand what has happened on your credit report. So we're going to show you in this presentation a summary table of what we see from examples of personal credit reports. So you can see that we're actually looking for trends. If your I'm not going to get into all of the nitty gritty, but it's not about the score. It's really about what has happened over the last 7 years that may have caused times of non-payment, times of delinquency. I see a lot of $100 medical bills, to be honest, that people don't even know exist, and they're dropping people's scores by 100 points. May even see a phone bill that someone co-signed for their sister that hasn't been paid. As long as we have an explanation, we again are bringing a human element to this, not just a scoring element. So we have an opportunity to understand what happened in your scenario and make a case for it, to be honest, because we know that everyone has life happens. People start their business because they lost a job. People have family members that get sick and everything is put on pause. We're not here to judge. We are just here to understand and be able to provide an explanation. So we've done financing for people with scores in the 500s, to be honest, because we knew that we could explain what happened. We've been through a recession in 2008. We're now going through, and will be going through, maybe even a longer one this time around. And personal credit is not going to be the sole deciding factor of how we make decisions. It hasn't been, and it certainly won't be moving forward. So if anyone has any questions before they start an application and they just want to have feedback, we are more than willing to not pull your credit, but we could review your credit report that maybe you can supply, and we can talk through it. All of our lenders have that expertise and can talk you through where are the things we're going to be questioning, and how can we overcome some of those what we call blemishes, because it's just a reality. We all have them.
Yeah. Let me just say that again, this is where the 60 to 90 days come from, because we need to thoroughly review your credit report, and is there something there that we see that's kind of negative? We need to find out. We need to get an explanation from you. We also search. We do LexisNexis searches, and that shows us. We do it for personally and for business. That'll show us if there's any liens against you, any liens from the IRS, from anywhere, and we need explanations as to what happened. Why are they not? Are they released? Are they not? Can you provide us information or evidence that they've been paid off, or that you have some kind of payment arrangements? So that that this is where the 60 to 90 days comes in. Again, there's been some projects that I've worked in that less than 60 days, but again, the credit's good, everything's in place. Other times there's not. So it's an average from 60 to 90 days. Next slide, please.
Great. So I'm going to move quickly through this. I think we've already touched on most of the fundamentals here. And I do want to just shout out to Michael. I see your question and we will get to it. Okay. I just want to make sure that we get through all of the presentation. So this is really the fundamental 5 C's of credit that go into the evaluation of your business. We are producing fairly lengthy credit memos that incorporate all 5 categories. And some of these categories are impacted by your business. Other categories are just macro and microeconomic conditions that really are outside of your control. So the first element of character is really tying exactly back to what Paul is talking about. This is how we evaluate you as a business owner, your experience, and your credit report tells us a lot about how you've handled credit in the past. But again, is just part of that larger discussion about what has happened and how have you been able to overcome some credit challenges. And that all ties into your character from a lender's perspective. The collateral is something we'll go over a little bit more in depth, but certainly this is the fundamental. We want to have skin in the game. We are investing in your business, and we hope that you are fully committed to repaying it and pledging business and or personal assets is something that we may require depending on the size of the loan, as well as the use of the loan. So that's a discussion that we'll absolutely have. Cash flow, we'll get into this, but this is just the basics of how is your business generating cash, and does it have sufficient cash to cover this new debt service? Again, just basic, and we'll go over some examples of some basic analysis that you can do on your own to really help you budget and plan for debt. Your capital, think of this as really your equity, right? So just as you started a business with equity, if you're taking on a large project in particular, building out a new space, buying a building, supporting your business through growth, we are going to expect that you have some equity and capital to contribute to that project. Most banks look for 20% equity or capital. We know that that's not feasible for most businesses, and so we have we've kind of cut that in half. We think about a 10% sort of minimum equity number, but I don't want you to confuse this too much with some of the working capital loans we're talking about, where we may not have a capital requirement. So think of the equity portion as really something more related to a larger investment that you may be making, and you're not necessarily looking for financing in survival mode, you're really looking to grow. We are going to want to see that you have some additional cash to contribute to the project. And then condition is just the market conditions. We pull some industry analyses that allow us to really better understand your industry. But we're really looking at, both the neighborhood and sort of city perspective and where you fit within your competition. And then we're also looking at what are the trends and changing trends of your industry. So if, and I probably don't have a great example for you, but I was just talking to a rental car business the other day who said his business had been fundamentally changed by Uber. And so, that is just something that was absolutely out of his control. He had built a phenomenal business over 10 years, and then Uber showed up and just dramatically changed the way he was doing business. And we're going to have to talk through that, understand how that impacts your business, and certainly help you reposition. Next slide, please. So this slide may not be very easy to read, and it's a little hard to present our online application in a presentation format, but I'm so pleased that PIDC has invested in this online option. We, for many years, were asking folks to fill out paperwork and sign their names through, just a traditional forms. We now are in the 21st century. We have a link to our application, which, as you can see, has about 7 or 8 tabs and goes through some just basic questions about your project, your need. We want to know, all of the sort of standard questions that a bank would ask. What are some of the your credit and financial history that we might want to know about? Again, I think if you take away anything, it's really that lenders don't like surprises. So we want you to be 100% transparent about what we're going to find, because we will find it. And we want to understand, your perspective. You'll see here that you'll kind of go through the tabs, you'll get to the end, and I just want to sort of set everyone's expectation that this application will take probably about 30 minutes to complete. So we encourage you to sort of do it in one sitting. You do have the opportunity to save your work and come back, but it's always nice to just carve out a half an hour, get it done, and by the end, you will have the option to upload supplemental documents. So the last tab, and I wish it was really the first tab, to be honest, but the last tab is the opportunity for you to upload securely. So you're not emailing these documents to us, but you can upload securely your supplemental materials, which we'll go over, and you click submit. And one of the things that we've learned from folks that have used this over the last month or so is that you have to actually submit your application almost twice. So you submit it, you then are verifying it and pressing submit again, and then it actually is being sent to us. So it is just sort of like a double tap. I just want everyone on the call to remember that you do need to verify before you submit. And you do have the option to save your work and go back to it. So I will take any questions about the online application or just the fundamentals of the 5 C's of credit before we move on. But I don't see anything so far in the chat. So Evelyn or Jasmine, next slide, please.
Okay, the narrative. This will be part of the business plan that you're going to supply to us. You're going to describe your key product and or services that you provide, describe the challenges and opportunities in the industry. Now, some people do provide us with really fluffy business plans that are big and really not say much. We want you to get, to the point. Make it short, but make it important, because you're trying to sell me with your project, and then I, in turn, like I said earlier, will try to sell the loan committee to approve the loan. Keep in mind that let me give you an example. We had a client that one day her and her husband decided to get a beer kit, how to make beer kit. They did it, liked it, and they started doing it. Both started working in different breweries, and now they came to PIDC because they want to open up their own brewery. Prior to that, they both managed different retail businesses. So we want to hear the story. Back in 2001, whatever it was, we decided to test the a beer kit. We fell in love with it. We both started working in different brewing. We now want to open our own brewing company. And of course, she can bring her management experience from her prior job. She worked in retail, I believe, as a buyer for Macy's. So you can bring that. So we want you to tell us the story of how you started and what exactly it is you want to do. Also provide us with any other financing sources. If you went to a bank and you've gotten a portion of the financing from the bank, and you're looking for the other portion from us, if you've gotten grants or anything from any government agencies, we certainly, SBA, we certainly want to know that. So you're going to put that in, and you're also going to let us know who the owners are. And what they own and what they bring to this project. You're bringing this person because they have this experience. You're bringing this person, they have this much experience in the particular business. So that's pretty much, the narrative or the what we call the executive summary that you're going to give us on the business. And also, you're going to be providing for us, which is what we review, the projections. You're going to provide us with projections on for the next 2 to 3 years, and assumptions, which are very important. You say you're going to do $100,000 next year and 200 the following. Okay, how are you going to do that? If you're a hairdresser, how many heads are you going to be doing? How many colorings? Or in your beer industry, how many beers are you going to sell to get to this particular projection that you just gave us? Next slide. I'm trying to get to as much as we can before we can get the questions at the end. Key attachments and supplements. This is what you're also going to provide to us, that we provide, that we need to do our evaluations and provide to the loan committee. Of course, the project budget, we're going to need estimates. You need equipment, we're going to need estimates for the equipment. If you need inventory, anything like that, we're going to need estimates. Renovations, improvements, we're going to need estimates. Because normally what happens at closing, if you are telling us that you're going to purchase $20,000 worth of equipment or computers, we're going to ask for the estimates, because we normally pay the computer company the funds. We will send a check to the computer company for that amount. So keep that in mind. Credit consent form, we ask for that again from anyone owning 20% or more of the business, because we will run a credit report on anyone owning 20% or more, or anyone guaranteeing the loan. Tax certification, we ask you to fill this out personally and the business. and you'll see the form. It'll ask for the EIN number for the business and your personal Social Security number. We send it over to the city, and the city will let us know whether you are whether you owe any taxes to the city. They do not tell us what they are. They would just say whether you're compliant or whether you're not compliant. If you're not compliant, then you will contact the city's revenue department and find out what taxes it is that you're not aware that you need to pay, and then you will either pay them directly, pay it full, or you will you'll do what we call a payment arrangement. You make a payment arrangement with the city, and then you will provide us with a copy of that, saying that, yeah, you are aware that you owe the city this amount, and you're making a payment arrangement. 3 years of business tax returns we need from the business, the past 3 years. We also need it from you as well, from anyone owning 20% or more. We also need your personal tax returns. Personal financial statement, this is a form that you will fill out. Again, anyone owning 20% or more will fill this out, and pretty much and I'll get into that because we'll get into that a little bit later. We have an example of that. This is pretty much like your balance sheet. You're going to tell us exactly what you own personally and what you owe, your liabilities. That's the personal financial statement. The interim financial statement is the latest quarter. This is for the business. If I were doing a loan with you right now, I would ask for an interim statement dated June 30th, 2020. So if your business is like a normal business, it starts January 1st and ends the end of December, then you would provide us with an interim statement showing us what the business has done from January 1st to June 30th of this year. That's an interim statement. 3 years of tax return, again, from anyone owning 20% or more. We asked for another form that we have now, which shows the existing company debt. So that tells us exactly all the liabilities that the company has, what the original balances were, what they are now, what the interest rate is, and what you pay per month. So we get an idea of the business debt. We also ask for that many times. For you to fill one out personally, because we also want to know what you owe personally, and we also back check that with the credit report to make sure that it makes sense. Because sometimes they may leave something out, or it doesn't make sense, and we have to go back to get explanation. Again, on the contracts on the contract line of credit, which is the program I talked about originally, we need copies of the contract that you are, of course, fully executed contracts that you are assigning to us. Some of the other supplements that we ask for, of course, are resumes. We want to know what your background is, resumes on your key employees. Appraisals, if we're taking a property, whether it's the business property, whether it's your home, whether it's an investment property, or whether it's your parents' home that they're pledging, we will normally need an appraisal to see, what's there. And then, of course, we look at what it appraises at, and then we subtract any existing mortgages. We need organizational chart. Again, you will normally, the organizational chart, you can provide us with that, or you can tell us in the narrative, I am the president, so-and-so is the vice president, and tell us, the organization, how the business is run. Articles of incorporation, we're going to need that. If you're incorporated, 3 months of bank statements, we need that, both personally and for the business. Of bank statements, and the most recent 3 months projections. I talked about that a little earlier. We need to know exactly what your projections are, what you're projecting the business is going to do. Aging log of payables and receivables. We're going to need to see an aging report to see what it is you have, receivables you have coming. And normally that's done in 30, 60, and 90 days. And the same thing with payables. What payables do you have to pay in the next 30, 60, and 90 days? Because we also take the receivables as part of the collateral. And we'll get into that in a little bit. That's part of the collateral. So we need to review those aging reports. Are there any questions?
I don't see any in the chat yet.
Okay, then next slide, please.
Great. So we're just going to quickly go over some of the, just the table that we evaluate for personal credit reports. And I apologize, I don't have a cursor here, but I do want to just point everyone's attention to, I'll just start from the left and move to the move sort of down each column. This summary table shows me a couple things about this person's credit report. The first is how much they have borrowed in installment accounts. The second is how much they've borrowed in real estate. So I know just off the bat how much they have in real estate mortgages and how many installment balances. Think of that as any other loan outside of a mortgage. So this, I don't remember exactly this case, but this would be a combination of student loans, most likely, when you see it that high of a balance, and auto loans, anything that's sort of a traditional term loan where you're paying principal and interest payments consecutively over the term. The next item is your revolving balance. So here I see someone really only has very little credit card debt here. They're showing a $54 credit card balance. Revolving balance can be translated to credit cards, just to be sort of to simplify it, or a line of credit, but most people don't have personal lines of credit. And then you move over to the right and I see, okay, so this is a very small credit card balance. We're seeing that they have 99% of their credit card balances available to them. That is excellent. One of the kind of, standard rules of thumb is that your credit score is typically impacted if you are using more than 30% of your credit available to you. So if I started to see this revolving available credit percentage drop below 70%, you would probably see an impact in their score. And we showed this is like, I never see folks in the 800s, to be honest. This is an exceptional credit score. But you can see it's primarily because they are showing very little credit utilization, which is in many cases unrealistic. But they have a lot of trade lines. So and the other thing that you want to kind of focus in on is the delinquency counter. This will show me historically over the last 7 years whether an account has been 30 days, 60 days, 90 days, or over 90 days is considered to be a derogatory account where it is in full delinquency. And here I can see this person had 0 late payments over the history of the last 7 years. So again, that's contributing to a very high score. We know that that's not realistic for everyone. A lot of times we see counters in the 30, 60, and sometimes 90 days. The health care bills that I was talking about earlier, and those Verizon or T-Mobile bills, if they show up on your credit report, it means not that they're there to show you positive credit history. They are there because you are delinquent, unfortunately. So those end up skipping right to derogatory, and we see major fluctuations in credit scores because of some minor bills in many cases. So we will certainly let you know and give you an opportunity to try to resolve that so that your personal score is enhanced. Our goal is that all of our borrowers and applicants understand what their credit report is showing and can tackle anything that may be either inaccurate or just needs to be handled so they can bounce back more quickly. And then the other 2 areas that I just want to highlight in that second column are the past due amount, the monthly payment, and your real estate payment. These 3, so it's actually 3 items. These 3 items are used in our analysis. So your past due amount is something that's going to trigger for us, okay, if they have an active past due balance, can it be paid off? If it can't be paid off before we close our loan, can they enter into a payment plan? We handle not only personal credit issues like this, but also, as Evelyn was mentioning earlier, when we communicate with the city to see if your tax clearance comes back, as well as through the state when we're pulling some background checks on your state taxes, we don't necessarily need you to pay them off in full. We need you to be in a payment plan. We need to know that you have agreed on a monthly payment that you can afford and that you have arranged that so that it will no longer be impacting your business and the state or the city won't be coming after you for past delinquent accounts. So that past due amount is usually a trigger for a conversation for us. Can you contact the creditor and make a payment arrangement? The monthly payment and your real estate payment are something that we combine to show that to show what your personal obligations are. With business credit, well, excuse me, with personal credit for business owners, we sometimes see that these amounts are commingled with business credit cards and other things that you may have either co-signed or guaranteed through the business. So we try to kind of separate out what is business related, what is personal related. We don't want to double count it for you, but we're not only analyzing your cash flow of the business, but we're also analyzing what we call a global cash flow. Understanding what are your personal obligations compared to your actual family and individual income to see that you can pay your bills, because part of what we consider to be our responsibility is that any debt that we are offering is not going to push someone over the edge where they cannot sustain their lifestyle and they can't sustain their quality of life. So that is just, again, all of these numbers, again, are not to work against you. It is just so that we understand where is your money flowing and how can we ensure that there aren't going to be any surprises with this new debt that we're considering. So you can move to the next slide, please. And I just wanted to show a contrast between a strong example and a weak example. And there's a couple of things here that are sort of interesting. On the left side, you can see they have a very similar installment balance, again, probably student loans. This person has a slightly lower real estate balance, on most likely a home mortgage or an investment property. Their monthly and real estate payments might be a little higher, but their revolving balance is interesting. They're not using any, at least at the time that we pulled this, they had a zero balance on their credit cards, which shows again that they would get a fairly strong evaluation from the credit bureaus. But what's really hurting this score, which is where we're dropping from an 822 to a 650, which again is not the end of the world, but it certainly is something we want to improve, is this extensive derogatory balance as well as over 90-day balance. 22 months, 44 months, that is something that has either just been, again, someone didn't know it was there, or they chose to ignore it thinking it wasn't going to impact them. I see a lot of times that folks have a very small balance, under $1,000, and they just let it linger because it's out of principle. They don't think they owe it, and they probably didn't owe it, but it was something, it was a miscommunication. So here, this is where we're going to have a conversation. We're going to see whether it makes sense for us to require the borrower to repay the balance. I think in this case, this was a $500 medical bill by that was actually someone's spouse's account, which should not have shown up on because it was a medical bill, it should not carry over to their married spouse, but it did. And so out of principle, this person was disputing that. But you can see, had they, sort of convinced their spouse to pay it, or even known that it existed, their score probably would have been 100 points higher. So we're going to have this conversation with every applicant if it's necessary, but the 650 or even lower is not going to be a reason for us to decline the application. And it's certainly not going to be just these numbers we're looking at. We're looking at every single individual trade line. This is just a summary table that we thought might be useful for folks that may not have looked at a credit report before. And I don't see any questions, so we're just going to move on through. Please write your questions down if you want to go back to them at the end.
And again, that's part of the 60 to 90 days evaluation that we do. That's why it takes, it seems to you, may seem to you that it takes long, 69 days, but it's really not. It's really not. Next is the income statement. This is what we look at. This is part of your tax return, or it can be, your P&L statement, your profit and loss statement. We look at your gross, you look at number one, your gross receipts. This particular business had about $357,000 that year, made $357,000. Their cost of goods sold was 109. Their gross profit, 251. And then from 7 on down is their the expenses the business had, the interest, the depreciation, rent, anything like that. So this business made $29,207 this particular year. So this business was pretty profitable. Again, this is what we look at, this line 21, to see to see what it is you're actually asking for, the loan amount, and can you service it? Can you service the loan amount with the $29,000 that you made the year before? That's kind of how we look at. That's kind of how we look at a project when we look at your income statement. Next. Your balance sheet. Next slide, please. The balance sheet pretty much states what the business owns and what they owe. So this is what the business owns and owes. If you look at the assets.
Oh, Evelyn, you're on mute somehow.
Okay. Do I need to go back to the other one?
No, it just happened.
Oh, how about that? Hang on a minute. Okay. Okay. Balance sheet. The balance sheet. This is if you look at the top, is the beginning of the year, rows A and B, which would typically be January 1st. The way the business was, in January 1st, the business had about $535 in cash. The end of the year being December 31st. They had 4,442. And if you look down, their current assets, there's a loan to shareholders there. There's building and other depreciable, whether it's a building, whether it's machinery, equipment, depreciation, and the total assets, if you look at it, it's $203,154. And then the bottom is the liabilities. Okay, how much the business owes in loans or whatever. In this case, is adds up to about 171,000. And then the number at the bottom, the 31,311 is the equity. So the way you want to look at a business is assets minus liability equals owner's equity, or E equals equity. So it's just like in the personal financial statement that I'm going to go over with you in a little bit, which is your assets, liabilities equals your net worth. So we'll get into that.
Evelyn, we have 2 questions for you right now in our Q&A. The first question is, what schedule of the tax return will you be taking for the business?
What schedule? I'm sorry, what was it again?
What schedule of the tax return will you be taking for the business?
We look at all the schedules. Is that what you mean? We look at for any business that you are 20% owner of, we will need tax returns. And the schedules, we look at the Schedule C, we look at all the schedules, because we need to see exactly what the business is spending and what the business has. If you look at this one, the balance sheet, it'll say at the top, you look at number 6, it says see statement 3, but we need to see statement 3, statement 4, statement 5, 6, and 7. We need to complete.
Oh, go ahead. Sorry.
Did I answer the question? I'm not sure.
Yes, the only thing I was just going to add is that some folks who have a Schedule C or a sole proprietorship, they may not have a separate tax return. It's just a schedule within their individual tax return. So right. That I'm, just wondering if that might be part of their question about which schedule.
Yeah, if you're a sole proprietor, you just have a Schedule C. But then we would also ask for like a list. Since you don't have a balance sheet, we would ask for a list of assets. What does the business have, so we can, or have the client prepare some kind of balance sheet. Whether will they prepare themselves so we can see exactly the position of the business, because we need to see, if we're taking the equipment for collateral or inventory, we need to see how much of it is there.
And what do you do if a balance sheet doesn't balance?
Oh boy. Which happens a lot more than I want to think of. But then we will go back to the borrower and have them review it and have their accountant, well, anyway, have them review it and have them redo it, because it's as simple as that sounds and as unbelievable. We do get balance sheets that do not balance. That they must balance. The total assets must equal, the total equities and net profit of the net worth of the business. It must equal. If you see the 203,154 must equal. If not, something's wrong somewhere.
One more question, Evelyn. Can the cash flow statement stand in place for collateral?
No, what was that again?
Can the cash flow statement stand in place for collateral?
No, collateral is I don't know what you mean when it says cash flow, because the cash flow is telling us how the business is doing or how the business is. The collateral is totally different. Collateral is what you would use to secure the loan, be it equipment, be it inventory, be it a piece of property, be it marketable securities, where the cash flow just shows us how the business is doing. I mean, we need that as well, but that will not be collateral.
Yeah, and the one thing I would add to that is that Paul might be, that's the same person who was asking about the contract line of credit. So one of the things that we do allow for sort of reduced collateral when we're dealing with the contract line of credit, because we have that contract cash flow as our collateral. So that might be answering part of your question, Paul, specifically regarding the cash flow financing. There was one other thing I was going to mention, but it just slipped.
The contract proceeds, is it the contract proceeds? And we do anywhere from receivables of 80 to 90%, depending on the industry, on the contract line of credit.
Oh, what I was going to mention is also we have seen folks, and this is very rare and it's typically a much larger request, but we have seen folks use their cash savings as collateral. And we'll get into collateral a little later, but that, I'm just trying to think of how you might be thinking about this cash flow replacement for collateral. If you are just looking to have, to reserve a balance of your savings and secure that towards a loan, we don't see it very often, but we can develop a mechanism to use that as collateral as well.
Next one.
Great. So this just is an example of how we start to give you, we add back a lot of your expenses on your income statement to evaluate your true cash flow for repaying and calculating debt service on our loan. So you'll see here, a lot of accountants and lenders will use the term Ebitda. And it literally is just a step-by-step process of adding back certain items from your income statement. So it's considered to be earnings before interest, taxes, depreciation, and amortization. And it's exactly what it says it is. We're taking your earnings, your net income, the last item, line 21 on most tax returns, your business income, and we are adding back your interest expense. We are adding back your tax expense, if there is a tax expense for your entity. We are adding back depreciation expense, because we know that that is really more of an accounting expense. It's not a physical expense typically in that year. And we're adding back any amortization expense, which is a little more rare. So your total free cash flow in this example is adding back close to $15,000 towards the total annual income that can be used to service debt. So that's a significant add back if you think about it. It could be the difference between borrowing $50,000 or $100,000. So those areas on your tax return and your income statement will be credited to you So you won't, if you have, for example, a year where your accountant is recommending a large depreciation expense, that will not work against you when we are analyzing your ability to repay debt. And I'm sure that there will be some questions about this, but I would like to go to the next slide because it's sort of a continuation of this. So in this case, this is the final calculation. Our hypothetical here is a $150,000 loan calculated over a 5-year term at 6.25%, which is right now our standard interest rate for the working capital equipment loan. The annual principal and interest payments are $35,000 a year, or $2,900 per month for the business. So we're taking this free cash flow number, which we calculated using the Ebitda method at $45,000. We are then assuming that we have a $35,000 annual expense for this PIDC debt. And our debt service calculation is just dividing the two. So essentially the $45,000 cash flow can cover 1.3 times the amount of this debt service, which is the $35,000 annual payment. And this is well within what we're looking for. Most banks are looking for 1.25 times coverage. PIDC goes as low as, in some cases, 1.1, in other cases, 1.15. Some of our products are 1.2. And then now with the pandemic and certainly the uncertainty of this year, we have reduced in some of our programs our debt service coverage to just 1 time. So we're not even looking for a buffer, which most banks would require. So I know that this might be, we might be working through this a little quickly, but we encourage you to actually do this calculation on your own so that you can start to see how much is a reasonable amount to be requesting based off of your financial cash flow. Next slide.
This is the personal financial statement. This is what I was talking about earlier. Think of this as your personal balance sheet. We'll require this from anyone owning 20% or more, or anyone guaranteeing a loan. And as you can see, section A is the statement of assets. And then the next column is the liabilities. You're going to tell us exactly what you have in your checking, your savings, if you have any marketable securities, if you have any real estate for personal use, meaning your personal residence. Below that is your real estate investment, if you have any investment properties. And if you see down below where it says real estate for personal use, it says, go to section 5. In section 5, you'll explain what year you purchased the property, who's the title to, what was the original mortgage, what is your current balance, and I believe what is your monthly payment. It'll explain that in another section. This is just the first page. If you go down, if you own a business, ownership in privately owned business, you're going to tell us what the net worth of the business is. If you have any automobiles, personal effects could be, your furniture, fixtures, art that you may have, or any other assets that you have. And then you total that one column, and that's your assets. And then the other column is your liabilities. Any credit cards you may owe, any mortgages you may owe, taxes owing. If you owe the IRS, the city, you're going to let us know, because then we will look at this and look at the credit report to make sure that everything was included. In the bottom, you add up the liabilities, and then you subtract that from the assets, which would make which would be your net worth. Just like business, your assets minus liabilities equals equity. This is your net worth. It will equal your net worth. Any questions on this?
No questions, Evelyn.
Okay. Next one. Okay, and this evaluating your business on the personal financial statement, exactly what I told you, your assets minus liabilities equals your net equity. It's just another explanation for you to remember, just like your business. Of course, we want to see that there's a positive. We don't want to see that you have more liabilities than you do assets. That we certainly don't want to see. Next slide. this is the collateral that we talked about that we're going to need for you to provide us information on. Minimum collateral requirements are personal guarantees. Of course, anyone owning, again, 20% or more will need to personally guarantee the loan. Liens on any business assets. We will take a lien on your business assets, be it inventory, machine equipment, anything you have. We will take a lien against that. Of course, we would also take a lien on anything that we are helping you purchase. If we're helping you purchase machine equipment, we will also take a lien on that. The next one's the assignment of proceeds from the contract. This is for the contract line of credit. Like I explained earlier, we will have you assign the contract to us, making sure that the payments come directly to us. Enhanced collateral, additional collateral in most cases will include mortgages on your personal home or investment properties that you may have. Lien on CDs, a certificate of deposit, or marketable securities have also been pledged, or liens on other personal assets. And we have had a client of ours provide us with took a lien on his boat. He had a boat. We thought that the loan didn't, the collateral available to secure the loan didn't quite make it, so we asked to take a lien on his fancy boat. So we have a lien on that. Spousal guarantees, we asked, especially if you're pledging your home and you and your spouse own the home, that the other spouse that is not part of the business or is part of the business provide us with the guarantee. Collateral, again, depends on the size of the loan and the risk of the payments. I don't know if you want to add anything, any other. And let me just say, this is where I gave an example first. Maybe you don't have enough collateral to secure a loan. Your parents, your uncle, or somebody may provide us with a piece of property or something. This is where this will come in, the enhanced collateral.
Yeah, and the only thing I would add to that is that, you know, one of the things I tell folks is, you know, if you have assets, we most likely will ask for security in the form of collateral. If you don't have assets, it will not disqualify you. So, you know, we encourage you to start the conversation with us. We, in some cases, can reduce the loan amount to accommodate limited collateral outside of the business. But we certainly don't want to discourage anyone who doesn't have that rich uncle or that, you know, just the general, personal assets that they may have acquired that will not disqualify you from financing.
And also, let me say that to please, I'm sure nobody in this workshop will do it, but please be sure to tell us the truth, because list all your assets on the personal financial statement, because I will find out, you know, if you don't, you know, you own a piece of property that you didn't put in there, because we, you know, compare to the credit report and to other LexisNexis and all, and we will find out that, you know, you're not telling us all the properties you own, because you may not want us to take a lien on them. So please be honest. Please be honest.
And we actually, Michael, I just asked another question, so we'll try to address both of your questions, Michael. And certainly we now can open the floor up to questions. I think this is our last slide. But Michael's question is the lien on your home, assuming, right, or other property, in lieu of the 10% equity required for the loan?
That depends. It depends on the loan. I mean, we certainly like you to do both. We certainly like, you know, to take a lien on the property and have you provide us with the 10 or 20%, you know, whatever it happens to be. I mean, it depends. It really depends. It depends on yeah. Go ahead.
Yeah, no, I was just gonna say, and one example is really, you know, when we're financing real estate. We are asking for 10% equity to support the purchase price, but then we are also taking a mortgage on that property. So you can kind of think of that as sort of a, you know, the standard example that yes, 10% equity is required, but it's not in lieu of other collateral. It is part of the overall required investment. And then Michael's original question, which kind of brings us back to the original conversation we were having about startups, but he says that he sees the common things that cause a loan to be denied may be many of them, which are common issues for new startup businesses, how can these be overcome? And if we're denied from PID, if the PIDC loan is denied, are there programs for new / startup businesses that they can be referred to that are more appropriate?
Well, we have the workshops that certainly Marla spoke about in the beginning. We have many workshops on understanding financial analysis, under picking the right accountant, or how to understand reading a contract, how to bid on contracts, different things like that. I mean, that can help you.
Great.
Or refer you to other different agencies. Again, it's on an individual basis. We would need to know.
Yes, and I think part of where that referral comes in, Michael, is understanding what industry you're in, what your business needs. Every single lender has slightly different specializations, slightly different appetites, and we've been doing this for a long time. We know all the players in Philadelphia, and so we'll make sure that any startup that comes to us is going to the appropriate resource. There are other CDFIs that specialize, for example, in food-based businesses. We know they're trying to build that portfolio. We have other partners that are bilingual lenders, and we'll make sure that we'll find culturally appropriate lenders for folks. But that is, again, we're here to make sure that you're getting the right referrals, and it always starts with these workshops. You're going to learn a lot from these workshops, so keep coming to them. The content is really great, and we have not only PIDC content, but we have a lot of outside speakers that come, as Marla had mentioned.
And there's also the library, the free library that has the Small Business Resource Center that you can get a lot of information from, especially if you're a startup, or looking to start a business.
Yeah, and we partner very closely with the Temple Small Business Development Center. They have a lot of great programs for folks that are just starting their business plan. A lot of folks start with SCORE. So there are, this particular session was not really geared towards startups, but we know that you have just as many needs, and so we'll make sure that you're directed to the right folks. We have a few minutes here, although we are about to, looks like, end on time. I know, thank you, Jasmine, for putting the PIDC financing link in the chat. It's all of the programs we went over are on our website. There are ways to get in touch through our website. You can submit an inquiry to get a phone call from someone on our team. At some point, you'll probably be talking to me or Evelyn. We also, he's not here with us on this presentation, but Arthur Jimenez works with all of our business applicants and helping them get their applications prepared and support their requests. So Arthur will be a familiar name for you as well. We're a small team, so you can email us directly, call us directly. We're certainly here to help. And if you know Marla directly, she'll make sure you're getting in touch with the right person as well.
Great. Well, Heather and Evelyn, thank you both so much. This is incredible information that most business owners rarely get the chance to hear. All they hear is either yes or no, and particularly if a loan request is a no, they're puzzled as to why. And so this information is invaluable for business owners to understand and get a peek behind the curtain, if you will, on how lenders are considering those applications. So thank you both so much. I want to remind everyone that we do on next week, Tuesday and Wednesday, the 13th and the 14th, we have our two-part series on buying and financing commercial real estate. Please go onto our website to register for that series. And then on Thursday of next week, October 15th in the evening, we're having a webinar called Technology for the Small Business. And that specifically is geared to helping businesses that have been applying to disaster loan programs and had challenges uploading documents, accessing portals. So we're going to walk you through the types of hardware, software, sizes that you should have in your computers to make sure that you are accessing all of the information that you need and not being rejected because your technology is not as sufficient or as robust. So on next week at 9 o'clock on Tuesday and Wednesday in the morning, the two-part real estate, buying and financing your commercial real estate. Thursday evening, technology for the small business. And then on the following Tuesday, we will begin our 6-month webinar series on Is It Just Me? Mental health during a crisis. That will be the third Tuesday of every month. That will begin at 9 o'clock, 1 hour. And then as we end October, we have a series that we're calling our neighborhood series. We planned this before the pandemic. We are continuing forward with it. So on Tuesday, Wednesday, and Thursday, October 27th, 28th, 29th, in the evening, we will have understanding and improving cash flow, optimize your operations, which is how to scale your business, and then ending up with sustainable growth, positioning your firm for the future. All of the PIDC webinars are available on the PIDC website, the PIDC blog. So if you think you forgot something or you missed something, go to our blog, look at the presentations, listen to the audio as often as you like. All of our webinars are free of charge. So we encourage you to come back, look at our website for everything that's coming up. Feel free to register, tell your network, and particularly for the mental health series that is coming up, it not only is for business owners, but for your employees and other providers who are dealing with levels of stress during this pandemic. So thank you again to Evelyn and Heather, to Jasmine, to Stanley. Thank you so much. And we look forward to seeing everyone on next Tuesday. So long.
Bye-bye.